Hello viewers, welcome back. In the last session, under the inventory fundamentals, we understood the terminologies used in the inventory management system, and also we understood the need for inventory group, stock item, unit of measure, and of course the godown or the location. So I had mentioned in the last session that we will see and understand how do we arrive at the closing stock, and how do you value that closing stock, since the valuation of closing stock is very critical and crucial, and which impacts the profitability of the organization. So in this session today, we will see the how do we arrive at the closing stock, and what is the formula. It's a simple formula. What is the formula that we apply to arrive at the closing stock? Now this session, especially for beginners, it is going to be very very important and critical, because generally in your in your college, probably as your theoretical subject, you might not or would have not encountered on these aspects. So this is very important for all of you to understand, and be very certain of how the inventory management needs to be undertaken in an organization where you are managing your inventory of the organization. So quickly, let me just share my screen. How do we arrive at the closing stock? So first, let us understand the simple formula for you to arrive at the closing stock. Now, there are two aspects to it. One is the quantity of the closing stock that you are holding in your organization at the end of the financial period. So, first, we will try and understand from the quantity perspective. And in the later part, we will understand how do you value them, and what are the challenges that we face, especially in case of a inventory valuation, and what methods are prescribed or generally adopted by industries across the world. So quickly, yeah. So first, the formula for arriving closing stock is very simple, right? So you have opening stock, okay, plus inward minus outwards is equal to your closing stock. Okay. Now, so quantitative. Okay. So let us say you have opening stock of say 100 numbers. Okay. So which would have been your closing stock for your previous financial year. Okay. So that becomes your opening stock for the current period, plus all the inwards. So you have an inwards of 500, okay, and then the outwards have happened is 300 numbers, okay. So finally your closing stock will be 100 plus 500 minus 300. So 100 plus 500 is 600 minus 300. So you have closing stock of 300, right? So this is the quantity of your closing stock of your various inventory items, right? So it could be in the form of raw material, in it could be in the form of work in progress, or it could be in the form of finished goods at various places, right? So which is what we saw in our first session. Okay. Now, so this is where you arrive at the closing stock. Okay, so now we know that we have 300 numbers as closing stock at the end of the financial year, and now we have to see what is the value of this closing stock. Okay. So before we go to the valuation of the closing stock, another important aspect that we have to understand about the movement of inventory. Now, why this is important for us to understand? Because in Tally, if you see, once we get into Tally, we will see how you are going to manage your masters and capture your transactions. So before that, we will have to understand that in Tally, basically you are having two sets of books of accounts, which is one is your accounting books of accounts, which we saw in our previous sessions, and the other one is your inventory books of account. Tally allows you to integrate your accounting books of accounts and your inventory book of account, where wherein you will have auto information of your inventory reflected in your financial statement appropriately, right? So before we get into that, so first let us try and understand the various movements of your inventory and the relevance of those movement and tracking of those nature of movement of your inventory. So let us take an example here. Let's say now this is your organization, right? So let me just, okay. So this is your company. So we will understand the movement of inventory. Okay. So one is that the inward. Let's if you take as a fresh inventory system in a new company, that when you're going to start managing your inventory, how does it happens? Number one is that inventory comes into your organization, right? So generally, how does this inventory come into your organization? So the inventory that comes into your organization, uh, majorly the inventory that is going to get into your organization is through purchase, right? So when you purchase inventory, the quantity of your inventory in your organization is going to increase, right? So let us say you purchase 100 numbers, right? So now we will see, okay, what is your closing stock at each stage. Okay, so you made a purchase of 100 quantities, right? So there is no opening and there is no outward. So at this point in time, what is the closing stock that you are holding? Is 100 numbers. Okay, now when does the outward of your inventory movement happens? Now again, generally if you see, the outward movement of your inventory happens through sales. So whenever you are making a sale, then the quantity of your inventory is going to reduce, right? So you purchased 100 numbers, and now let us say you have sold 50 numbers, right? So the first instance we had 100 numbers, and now in the second instance, if you have to arrive at your closing stock, 100 is inward, 50 is outward. The closing stock that you have is 50. Okay, so these are the primary movement of your inventory through purchase and through sales. Now, there are other ways of inventory moving into your organization and out of your organization. So, what are the other ways the inventory is going to come into your organization or move out of your organization? First, let us say the inventory moving out of your organization, not by way of sale, but by way of other instance. What is that other instance? Now, the movement outward of your inventory, the other way of inventory movement out could be because of your purchase return, right? Purchase return, right? So you purchased 100 numbers, you sold 50 numbers. Now at later point in time, let us assume that you discover that some items are damaged, which you are now going to return to your supplier, maybe for replacement of new item, or you might be returning it back so that you would not want any replacement to happen. Okay, so whatever is the case, we will see again what happens in case of a replacement and how do you track them, and what happens in case of a non replacement. Okay, so in this case, when there is a purchase return, again the quantity of your inventory in your organization is going to reduce. Okay, let us say out of 100 you are returning five numbers. You are returning five numbers to your supplier, right? So now, in the third instance, what is your closing stock, right? Purchased 100, sold 50, and 5 is gone out by way of your purchase return. So the closing stock that is lying in your organization with the third example is 45, right? Now, the other movement of inventory into your organization, not by way of your primary purchase, would be that uh, the another way where the material is going to come into your organization is, yes, you have guessed it right, is due to sales return, right? So sales return, you sold 50 numbers to your customer, and your customer finds out that there are 10 numbers of that item which is damaged, which the person is going to return to you. So now the sales return that has happened is 10 numbers. Okay, now what is the closing stock that you have in your organization, right? So in the fourth example, or the fourth instance, if you take, the closing stock that is going to be lying with you is now going to be 55 numbers. So you already had 45 and 10 numbers have come back to you, right? So 55 is the closing stock that you are having. So this way, especially when you are using Tally, you will see that automatically, the value or the quantity. When I say value here in this context, it is the quantity. The quantity of our inventory will add up or will increase in case of purchase. The quantity of your inventory is going to reduce by way of sale. The quantity of your inventory could further reduce because of purchase return, and the quantity of your inventory could increase because of your sales return. Okay, so all this happens automatically, and your closing stock Tally gives you instantaneously once you start capturing these transactions using the relevant voucher type that Tally provides. So in case of purchase, you use a purchase entry. Now here what happens now, this, so the sales return, what is the voucher type generally that you use in Tally for a sale return? We know that it is credit note, because in our accounting sessions we had a dedicated video which talks about understanding of the credit note and debit note. So if you have not seen those videos, I would definitely recommend that you see those videos, because in detail I've explained about the need for credit note and why the terminology credit note is coined. Similarly, the debit note also. So generally, again, when you make a purchase return, right? So you are going to raise a debit note. You're going to raise a debit note. So this way, if you see now, all this one, two, three, four voucher type are accounting voucher type, which we have seen already, right? So by now, once you enable inventory module in Tally, and now when you start capturing these four transactions, the purchase entry, your accounting information also is going to get updated, which means basically on your expenditure side, your purchase value is going to get added. And if you are making a credit purchase, then on the liability side of your balance sheet, in your sundry creditors balance is going to increase. So one debit on your P&L account, which is your expenditure, and one credit on the liability side of your balance sheet, which is credit. So again, the double entry system principle works there. So similarly, when you make a sale entry, right, the sales information gets updated in your books of account, and also the inventory quantity will automatically reduce once you pass the sale entry. Okay. So again, similarly, in case of a credit note, the inventory quantity, to the extent of inventory quantity that you are accounting in your credit note, to that extent your closing stock quantity is going to increase. Similarly, in case of a purchase return, your closing stock is going to reduce. Now, these voucher types in Tally are called as integrated vouchers. So, what do you mean by integrated voucher? I had mentioned just now that you are maintaining two sets of books of account. One is your accounting, your financial accounting books of account, and also your inventory books of account, right? For tracking the movement of your inventories, right? So, so now there are, if you see, uh, like I'd mentioned, you there are certain vouchers, or there are certain transactions where you would not want the financial books of accounts to be impacted, but then you need to use these transactions, or you need to use this voucher type to have an impact of your inventory books of account. Okay. So what are those transactions where only your inventory books of accounts is going to be impacted, and not your financial books of accounts? So again, for each one of them, you have a pure inventory transactions for accounting of movement of your inventory. Okay. So in case of a purchase, so when you make a purchase, we know that the quantity of your inventory is going to go up. Okay. Similarly, if you want to have only an impact on your inventory books of account, so instead of purchase, there is a voucher type in Tally. Now these voucher types are called as pure inventory vouchers. So we will get into the detailing of all this once we go into Tally and enable inventory module, and then start working on inventory module. But it is important for you to understand this at this point in time. Okay. So purchase, so that means purchase is going to increase the quantity of your inventory in your books of accounts. Similarly, a pure inventory entry, which is a substitute for your purchase, is your receipt note. Receipt note. And generally, the terminology that we use is GRN, which we saw in our previous session. So GRN stands for goods receipt note. Okay. Now here again, the quantity of your inventory is going to increase, where it reflects as part of your closing stock, but then it is not going to impact your books of accounts. So that's your receipt note. Similarly, in case of a sale, what happens is that instead of sale, for you to move your inventory out of your organization, you have a pure inventory voucher in Tally, which is called as delivery note. Okay. Or generally we use this terminology called DC. So again, DC stands for delivery challan. So whenever you raise a delivery challan in your books of accounts, then it is going to reduce the quantity of your closing stock to the extent of the quantity that you are entering in your delivery challan. So again, all the transactions that is made through delivery challan will not impact your financial books of account, but it will impact your inventory books of account. Okay. So now you have this credit note, right? So for credit note, again, a pure inventory entry could be, there is a voucher type called rejection in. So the word in itself gives you a clear understanding. That means rejection in is material coming into your organization, not by way of purchase, but by way of sales return. A rejection. So that means a rejection has happened, and you are now inverting the quantity of this rejection into your organization, so that it to the extent of the quantity that you capture here is has to now add up to your closing stock. So you make a rejection in entry. So let's say 10 numbers is the example that we took. So you make a rejection in. Now again, this rejection in uh, uh, could be of two types. So one could be the rejection in. Generally you take it here, and probably you rework on those item, or replace some of the defective parts, and then you return it back to the customer in the working condition. So that is where you use this inventory, because in any case you are not going to reduce your invoice value. Supposing if the customer is returning the material, and he says, now I'm returning this material, but I don't want replacement, kindly reduce my outstanding. So in that case is where you are going to pass a credit note, so that now it has to impact your books of accounts of your finance and also inventory. So when you pass a credit note with the inventory information, the outstanding amount in your sundry debtors ledger is going to reduce, and your sales, the original sales that you have already captured, is also going to reduce. Now with the value of the material that is getting reduced, to that extent your sale is also come down. Okay. And also, because a credit note is an integrated voucher, it also increases the quantity of your closing stock in your books of account. So this way, now you can actually track the movement of your inventory into your organization and out of your organization, identifiable with the specific nature of transaction. So if it is a sale return, you will also know that, okay, these are the material which has come into your organization by way of a sale return. Now if you make a rejection in entry, then you can actually repair them or replace components like I mentioned earlier, and then you can send it back to the customer. So that way the amount of the sales invoice amount that is outstanding with your customer is not going to reduce. Your sale is also not going to reduce, because you are just repairing it and then replacing it. So if you receive it through rejection in, you make the defective piece in a working condition. So how do you now give it back to your customer? Because this is not a sale, right? So when it is coming back to you, it is coming as a rejection inward, and this I'm not going to impact my uh, accounting books of account. So once you have worked on that inventory, and once the inventory becomes usable, then you will supply that back to your customer through a delivery note, right? So when you make a delivery note, then what happens, to the extent of the quantity that you are delivering, it is going to reduce that quantity, and it is going to update your closing stock. The other instances where you would use a delivery note for a pure tracking of your inventory is that one example that we can take is that in case of a job work, where again Tally has a very nice job work module. So when we get into that job work module session, we will discuss in detail. So in case of a job work, what happens? Just for the beginners to get an idea, a job work is something where I am providing my material to a third party to basically do some kind of a work. It could be a manufacturing activity, it could be a processing activity, and he is going to return the material either in the same form with some kind of a processing undertaken for that particular material. So example of process, I could say that, let us say I am into manufacturing of furniture. Right now I don't have this powder coating. So normally, for your furniture you need to have this powder coating on your furniture for it, for the furniture not to be rusted. So I don't have that powder coating machine. I don't have that system in my organization. So what I'm going to do now, I'm going to finish my chair, everything, and then chair or my table, and then I'm going to supply that material to my job worker, where he is going to now powder coat on those material, and then he is going to return back my chair and table. So in this case, what happens, I'm going to give him A as an item, and is going to give me a back with some additional value add in case of a inventory activity is done it. So in that case, I'm going to issue a delivery challan, because I'm not making a sale, I'm not selling to him, because I'm going to get it back again. So I'm going to issue a delivery challan, and now you will have all this different type of movement tracked in your books of account. Again, it is very important. That is what we saw in our first session. So how do you track your various form of your inventory? So you will have to know how much of material you have given it to your job worker, how much of material is returned, and what amount of material is lying with your job worker. So all this can be tracked by you using the designated voucher types that Tally provides you. So I'm going to give a delivery note, and then once he finishes the work, he is going to now return it back to me. So now once he returns back to me, now again the quantity of my inventory is going to go up in my organization. Now this is not a purchase, so I can't use a purchase voucher. So in that case, what I'm going to do, I'm going to use a receipt note, so where the material is going to come inside. So my delivery challan is not impacted my financial books of account, my receipt note is not impacted my financial books of account, and through delivery note, whatever material that I have issued, it is reduced the quantity in this thing. And we will also see when we come to job working that should it really reduce the quantity of your closing stock values. Currently we're not discussing about valuation, we will come to that in the next session. So whether it is going to reduce this value, or should it remain as part of your inventory, and how do you handle the valuation part, we will see that. So currently, just for us to understand in a simple way, delivery note, material is going out, right? So the material is reduced, I mean the quantity is reduced, and once you make a receipt note, material is coming into your organization, and you are now able to the quantity of your closing stock is going to increase. So similarly, like I had discussed about rejection in, to make it short, the rejection out, if you see, is that, again, you could be sending some defective material back to your supplier for it to be reworked or repaired, and then get it replaced, or it could be a replacement also. So in that case, again, you are not going to impact your books of account. So what you're going to do is that you are going to use a voucher type in Tally called rejection out. So out means material is going out by way of rejection. Now again, at any point in time, if you want to see how much of material is lying with your supplier which needs to be replaced, so through these independent voucher type, you are able to clearly track the inventory in your organization. Right now, there is one more type of voucher type which we need to understand here, is that we discussed about the Godown or the location, and we also understood in the previous session what is the relevance and importance of the Godown, especially when from your stores, when you're giving it to your production floor. So material is moving out of the stores, and it is going into your production floor, and you need to now know what items are lying in your production store. Now in this case, if you see, important aspect you have to understand here is that when you make a receipt note or a purchase voucher, the quantity of the material is coming into your organization, which is going to increase your closing stock. When you're making a sale or when you're making a delivery note, then the quantity of the item is going to reduce your closing stock quantity. So similarly, in case of a credit note or in case of a rejection in, the quantity of your closing stock is going to go up. In case of a debit note or in case of a rejection out, the quantity, sorry, the in case of a rejection out, yes, the quantity is going to reduce. All right. Now, when I'm moving my item, let us say I'm moving the raw material from my stores Godown or from my raw material Godown to my production floor. So now what happens? Now I'm sending the material from one Godown to another Godown. So in this case, you have to remember, very important, that you have to understand, in this case, neither the material is moving out of your organization nor the material is moving inside your organization. It is actually getting transferred from one location to another location. So if you could just recall the concept of contra entry that we saw in our accounts. So in the contra entry, what is happening? Quickly, when you make a payment, the money from your organization is going out. When you make a receipt entry, it is not a receipt note, it is your accounting receipt voucher. When you make a receipt entry, then the money is coming into your organization. So what happens in case of a contra entry, right? So in case of a contra entry, neither the money is going out of your organization nor it is coming into your organization. Only thing is, money is moving from one account to another account. So the account from where money is moving out, the balance of the amount is going to get reduced in that particular account, and the balance of the amount is going to increase in the other account where the money is coming in. So example of contra entry, when you withdraw cash from bank for office purpose, so the balance of the money in the bank account is going to reduce, and to this exact extent, the money of cash balance is going to increase. So that is why we say this as a contra entry. Similarly, in inventory, you are moving material from one location to another location. So again, another example that we took was your factory and showroom, right? So factory is in one location and showroom could be in completely a different location. But then once the your finished goods is ready, you are going to now move this finished goods from your factory to your showroom. So now in this case, even though physically the material is moving out from one location to another location, it is neither it is not a sale, right? So the value of the inventory should not get reduced. Your overall inventory stock should not get reduced. Only thing, yes, from location one. So what you do is, when you create multiple godowns, then for example, I will say this is my factory. So this is going to be my one master where I am going to track the inventory. So all the inventory that is lying in factory, when I go to the report and when I say I want to know what is the inventory that is lying in my factory, you will get the report of all the inventory that is lying in your factory based on the grouping that you have already done. Okay. Now I have my showroom where I am transferring the material. So that means, now what is the closing stock that we are having here based on all this transaction that we have discussed? So we have 55 numbers, right? So now in factory, let us say I am transferring 10 chairs which is ready after I have given it to my job worker. He's done the powder coating and it has come back to my factory. Now the chair is ready to be sold. So now what I'm going to do, I have to now move this 10 numbers of the item from my factory to my showroom. So now what happens is that the quantity of the item, which is my furniture, let us say example is furniture, then this quantity has to come down, it has to reduce here, and it has to increase there. So Now the material, even though it is moving from one location to another location, still it is going to be within your organization, right? So now, does it have an impact of moving from one location to another location? What impact it has on your closing stock? Zero impact it has on your closing stock, because it is still going to be your 55 only, right? Because you are not sold, or you are not sent out through a delivery note. So what is the voucher type, or what is the uh, record that you are going to capture here? Now whenever there is going to be a moment happening from one location to another location, either from here to the other location, or from the other location to the previous location, right? So you use a voucher type in Tally, which is called as stock journal. Okay, and the stock journal is a pure inventory voucher, which is not going to impact your accounting books of account, right? So these are the different voucher types that is required for you to understand before we get into Tally. And I hope that we have understood the different voucher types, and we also understood what do you mean by integrated voucher type, and also what do you know by the pure inventory voucher. Okay, so quickly as a recap: your purchase, your sale, your credit note, and your debit note are your integrated voucher, which impacts your accounting book and inventory book. The pure inventory vouchers, which will impact only your inventory book, are your receipt note for the material to come into your organization, your delivery note for the material to go out of your organization, your rejection in, which is going to, again, material is going to come into your organization by way of your sales return, or as your replacement of your sales activity. Rejection out is going to be the reverse of your rejection in, where whatever material you have purchased, you are sending it back for replacement purpose. So that's your rejection out. And the last voucher type is your stock journal, where basically it is like a contra voucher. So it will reduce the quantity in one location from where the material is moving out, and it will increase the quantity in the other location where the material is moving in. But if you see the overall impact of your closing stock, the overall impact of your closing stock is going to not have any change in your closing stock quantity. Okay, so in the next session, we will discuss about the closing stock. So we have understood this. So this should give you more clarity, and we will see how the closing stock is arrived, and also we will touch upon the very important aspect of your valuation of your closing stock. Thank you all for staying till the end. See you all till the next session. Thank you very much.